Focus. Ideate. Innovate. Enable.
Welcome to another episode of the CNBC TV 18 Investor Camp, and once again we're here in our favorite city, Bengaluru. Times have been a bit rough for the market, Anuj, but this city has been so warm and welcoming to us. It will be a great day today.
It will be. In fact, the weather is so nice, and this is part of our Inside Bengaluru campaign as well. And I think this clearly, quite a bit of nice air here in Bangalore. People are so savvy, market savvy, so many startups, so many young entrepreneurs. And I think we'll learn a lot from the audience here today. Yes,
we will. And the last time we came to Bengaluru, the market was just reaping the fruits of the big bull run. This time things are a little different, but we'll find out more from our savvy investors in just a bit. You know, we've had great times in our market, and we've seen it, right? All through the bull run when it started last year. But this year, things have been a little patchy. In the last couple of weeks, you've been calling the market, a lot of volatility. You expect that to continue?
Well, Sonia, yes, your point is right. The market has been quite volatile all through this year. But I tell you one thing, this is what the market is all about. Last year, we had an easy top-down market run. You know, the index went up. You could have got any stock, you could have bought any stock, and you would have made a lot of money. This year it's been difficult because the Nifty is flat, the Bank Nifty is flat, but the mid-cap index is at an all-time high. The Nifty Junior is at all-time high. A lot of stocks are at all-time highs. Last year was a top-down market. This year is what the stock market is all about, stock picking. Individual bottom-up approach, getting it right. If you get it right, you make a lot of money. I mean, I know so many funds, for example, where NAVs are at lifetime highs without the market being at all-time highs. So the sense you get is that the market is going to remain volatile. Earnings are not catching up. That's clearly the biggest risk. We've seen over the last 3 or 4 days there have been some negative surprises as well. So that's going to keep a lid on the Nifty. At 8600, 8700, the risk reward does not favor you to take a large position on the index. But at the same time, if you are sticking with the quality stocks, the leadership stocks, they're higher than what they were 6 months back, and by quite a margin.
You know, Anuj, the thesis or the basis of every bull market is earnings recovery, right? And so far, we haven't had any conclusive evidence of that. Do you think that the market is pricing in a lot more than has actually come through?
It would be wrong to just, say that overall earnings are not recovering. There are some sectors which are under pressure, and that will take time. The sectors which are related to economy to grow well, that will take time. The economic recovery is clearly not visible right now. But one thing is for sure, market will factor that in 2 quarters ahead. So, you'll see the market rally. The companies will still report bad earnings because the market would have factored that 2 or 3 quarters later, the earnings recovery would take place. The market will hit all-time high, and after that you'll see 2 or 3 quarters later earnings picking up. That will happen for sure. That's the texture of the bull market. That's the nature of the bull market.
Well, now let's listen in to our first speaker of the day, flown all the way from Delhi just to give you advice, Ajay Srivastava of Dimensions Consulting.
Opportunity cost of capital is the lowest in the decade, ever. People are willing to put money in for a return of 12, 15, 30, 20% easily, even in India. We have seen days when people used to say, if you've not doubled our money, what have you done in this country? Today, people are very reasonable, internationally, globally, India-wise. The opportunity cost of capital is low. Therefore, expectation of return also is calibrated. Why India is so great today? Why we are so bullish? And there is a reason for that. And the reason is partly political. We have first time a government which does not really subscribe to the philosophy of the left. Please don't take a political connotation of right wing. In a positive sense, I say, for the first time, it's pro-business. It's economically for the people who sit here, right? So away from the left paradigm, when we move around, they have the courage to say that corporate is priority one. I don't know why they're still now shying away. But we love that, saying that, listen, companies are number one priority. We want the coal companies to go up. We want the steel companies. We want infrastructure. We want IT. We want everything. And therefore, there are P1. So there is a reason why we like India market is because corporates have for a change become priority. Doing business is not bad news. And the next one is the banking industry. A lot of us in the market feel that banking regulator has let this country down. there is a fair argument in that. You already seen the debate on the interest rate central government wants to come in very quickly. And I think that's the corollary to that is that the banking industry has done the best in the industry. We do not have in the world a comparable case of 4% net interest margin enjoyed by HDFC Bank. There is no comparison in the world. And the reason is, this market is a controlled market. This market doesn't allow new participants. We just had one license in 10 years to Yes Bank and maybe a few more down the pipeline. So imagine a scenario where central bank says, no new players in the market. I want existing guys to make big money. That is why banks make big money, private banks make big money. We all made big money backing the private banking industry. The banks, the RBI, today is strongly supporting the promoters, which gives you comfort that should there be an event, global events, demand, supply, etc., we will see RBI coming in and helping out the corporates. You've seen the restructuring. We may not like it ideologically. The 525 is the silliest, absolutely globally the silliest measure in the world on restructuring, but let it be so. And why we think investment is very important in equity markets? The reason is very clear. Do we have options? You got money in the bank, what do you get? 7%, 30% tax rate gone, 5% return. That doesn't cover you for inflation. Where do you go? Gold. Last count, 25,000 and counting and below. Silver, 32, 33,000 counting and below. Real estate, you can't sell it. You may have it, you may think it's got value, you can't sell it. So what does it do to an average investor? For people like you, people like me, everybody says, we actually go back to the equity markets, and that's what. We don't have a debt market, which is mature, so debt market is also out. So ladies and gentlemen, we are, whether we like it or not, victims or beneficiaries of equity market in this country. India is, right now, it's like a two-phase situation. The real economy is in despair. The investor sentiment is with a lot of expectation, is buoyant. And therefore, a lot depends upon the performance as we go down the next 2 quarters for the bull story to remain intact. Having said that, irrespective of what happens to the bull story, there are certain sectors which will perform and outperform the market on the long term. The first sectors like pharma, telecom, the MNC as a group, as a companies will, I think, outperform the market irrespective of where the market goes.
Well, that's the word coming in from fundamental market expert Ajay Srivastava. But we're not done just yet. When we come back from the break, we'll hear it out from the tech guru, Sudarshan Sukhani.
Welcome back. You're watching Investor Camp coverage from Bengaluru, and you saw how Ajay Srivastava made some interesting points about the fundamentals of the market. But what about the technicals? They say trend is your friend, and who better to give you the trend than Sudarshan Sukhani? So let's just go across to the tech guru, Sudarshan Sukhani.
You have to look at blue chips, the best of the best, and then go for it. Buy on dips, buy blue chips on dips. Please don't dabble into a mid cap or small cap and then say it was 20 rupees. When it came to 12 rupees, I bought it. Now it is 1 rupees. No, please don't. That's why I never talk about mid caps on TV. I know all of you will fall into trouble. This is not the way to make money in this market. We are not speculators. We are investors. We are participating in the growth of this fantastic country. We are in the best of the best environments. We are not here to make 1 rupee shares into 10 rupees. That's not our job. We are simply here to make reasonable, good returns. Buy on breakouts, buy on dips, but because breakouts are much more difficult to identify, and we are already in an ongoing up move, every time you see a correction and you sense and you get a feeling of comfort, just go and buy it. You are never going to buy at the lows. I have to repeat it again and again. If you wait for that ultimate point, 10 points closest to the low, you'll never do it. Only Elliott Wave theorists do it. They never trade, they only advise. But you, again and again, I tell you, you are real investors, you are real traders. One more point which most of us don't make is that there is a concept of asset allocation. All of you understand it. You never put all your money in an asset class. You have stocks, you have gold. Little bit of gold is essential, not gold ornaments, perhaps liquid or demat gold. Bank deposits are a part of your portfolio, and if you have a business, that itself is an investment for you. So your financial advisor will tell you what percentage of your capital should go into stocks. But my point in showing this was that you have a bigger picture, and that includes all of this. But in this time and period, as much you can put to stocks, the better. Because stocks are certainly going to outperform. Not in the next 3 months, not in the next 6 months, but over a period of the next 5 years, 10 years also, stocks will outperform. The markets went through a period of a 5-year consolidation from which it broke out in 2013 above 6350. So when the market consolidates for so many years, the eventual outcome of that is a bull market that lasts much higher in terms of price and for a significantly longer period of time than the period of consolidation. So a 5-year consolidation can easily lead to a 10 or even a 15-year bull market, and a rally that could be 3 to 4 times the highs seen in the previous bull market. So at 6,300 when we topped out, the next target for the Nifty in 10 years, 15 years or 5 years could be 25,000. So the theme is to look beyond, look into the future rather than look into the past. When we start thinking in terms of the past, we look at the Nifty at 8,000 and start feeling, if we come back to 8,000, I'll be a buyer in this bull market. But that's not the way to approach this market, to approach any bullish scenario. We should look at a target of 25,000 and say, the Nifty can be 25,000 in 5 years, 10 years, 15 years. If the answer is yes, then at 8,500 today, we are in a perfect buying opportunity. That's the broad theme. Look to the future. This market is just in the beginning stages of a bull market. Expect much higher levels and a significantly larger amount of time for the upside. So stay invested, keep on doing SIPs, keep on buying.
Well, that was some technical advice from Sudarshan Sukhani, but we have one more speaker, Kapil Bali of Yes Securities. Let's hear him out.
Basically, when we talk about equity markets, again, we start thinking about, the family starts getting away from the market because it goes up, it goes down, every minute there's some news coming in, there's a knee-jerk reaction. While when you are in property, you all go to see a flat or a house when you are buying, you're all together in that decision. While in this it becomes a little complicated, or is it our fault that we have made it very complicated? When we talk about numbers, we talk about ratios. At the end of it, it is basically the health of a business, the health of a property, the health of an asset class. Now, there are some parameters on which we should assess all asset classes. When we talk about property, you go in with a very large chunk of money, while equity or gold or other asset classes or FD give you an option of going in it with small and disciplined way of options. So there are plus and minuses to most asset classes, and in most of the parameters you will find that the equity class has more benefits than minuses. Usually what we all think is an investor is an individual, while as an Indian we are heavily into our families. So even our investment decisions are family oriented decisions. So we may have various investment avenues, and we choose all these avenues as per our family needs. Same goes with the long-term investment in the equity markets. So when you see whether a family invests into gold, whether a family invests into property, whether a family invests into FD, and similarly whether a family invests into equity market, there is a consensus in the family. So it's not an individual we are talking about. Similarly, the changes which all have been happening in the last, especially 2 years with the coming of the government, new policies coming in, these are having an impact. There's a discussion happening among spouses, among the family, among their extended families and friends, how to go about investment. It's a great time to be in the Indian economy, and the Indian market is a representative of that economy. So the investor today is looking at various options, and among the various options, the equity market is looking much better than other options. Gold no more is the safe haven which we all knew from generations, that it gold mein dal do and this will make money. This is not so. In fact, if you see, for the first 20 years in this 30 years, it is around a $500 mark, which is continuing to be for 2 decades. It was around $500 mark. Suddenly, in 7 years, 5-7 years, it started shooting up and went majorly up, and now we are down to 5-year low. So we don't know. Nobody knows whether this is bottomed out, whether this will go down, this will go up. So until unless it's a consumption which is required, it is still very dicey to play on it.
With that, we slip into a short break, but when we come back, it's the most fun part of the camp, our interaction with the audience. Stay with us. Welcome back. You're still watching the CNBC TV 18 Investor Camp, and we're here in the beautiful city of Bengaluru. Well, we heard it out from our market experts, but now the most entertaining part of the camp, our interaction with the audience. Let's listen in.
Generally, it is said that once we buy the stocks, we should just invest them for 3 to 5 years and forget about it. So, is it that in the middle we should review them, book some profit, or just totally forget about them?
See, I think whenever I believe very strongly, whenever you're investing in something, even if it's an FD, so you have a tenure in mind, or you may think that, okay, when I need the money, I'll take it out. With a pinch that if there is a liquidity issue, obviously I'll get out of it, even pay a penalty to the bank or something like that. Similarly in stocks, you decide, see, I'm convinced with this healthy story, but it is at this point of time you're making a judgment. Obviously you will have to review and keep abreast of what is happening in that stock or what is happening in that company, and you need to be convinced by the company that your decision is okay. So it doesn't mean that when you started off, yes, you wanted to stay invested for a very long period of time, but obviously if you feel that the things are going or you feel that there is something else which can come in and you have made certain gains, or you have made a benchmark that I want to get out after a certain milestone of say 15, 20, 30, I don't know, and then you look at something else. So it's a call, or you may even like to then go into some other asset also. So that's a call. You just don't blindly follow a number that I will definitely stick to this number.
I would like to ask about the impact of global economy and its trends on the Indian equity market, particularly the American economy, the European economy, Chinese, all of them are going down and down, and there's a lot of pressure also on the Japanese economy. Whereas in India, what will be the impact of these economic trends onto the Indian stock market, and how we as investors should look at it? Should we shift our view from multinationals and multiple exporting companies to companies which are prospering by producing and selling within India?
Europe is the biggest problem area, not US. In fact, if you go down to China, you'll be surprised at the level of optimism in that economy and the growth they are facing. You know, numbers belie everything. Do we feel like a 7% growth economy? The answer is no. Do they feel like a slowing economy? The answer is no, equally no. But the lesson for us is very simple. One, there is enough liquidity being sloshed in the market and it's not going to go away, which allows you the freedom to price your shares, price your stock offerings, get capital for yourself in the country. Great positive. Liquidity is surplus, so you can get capital. The great negative is there are exports are sluggish. The good part of the exports being sluggish is that not many listed companies in India by and large have huge exposures to export industries, leave aside IT and some extent pharma. So to the extent our FMCG companies, etc., engineering companies are more domestically focused, so domestics will play a bigger role. So I'm not convinced that the so-called adverse global environment is going to be a big dampener for us. I think what we have to take it forward is that is giving us a chance of a lifetime to get the capital we could have never imagined, one. Number two is, it is also giving us a chance of a lifetime to become competitive in a scenario where global product prices are falling, but we are not becoming export competitive. You've seen export data, I think 10 months, 12 months has been, Anuj, am I right? It's been below,
Yes.
It's been degrowing. So there is a challenge there as well, but the important for equity investors by and large is that there is enough capital to back up India's growth story, because we want to grow at 8-9%, we don't have enough money. So one takeaway simple is, whatever is happening globally is supportive to India's growth story on a macro front than a negative.
We keep hearing from Sudarshan sir, that the markets are going, or any stock is going much lower. That's something which we keep hearing. So from a chartist point of view, how do we come to know which is the stock? Even from an investing point of view, maybe it is better to defer for 3 to 4 months, or Because obviously, even a good stock like example, say HDFC, if it is going to 800, why to buy at 900 and wait for? So is there any objective criteria which we can have from an investing point of view?
There is no objective criteria. There cannot be, because if there was an objective programming criteria, mathematical criteria, everyone would buy at that level, and that price would never come there. Primarily, you are an investor. As an investor, if one of the 15, 20 blue chip companies that you have in your list fall enough for you to say, okay, let me start thinking about it, that's the time to buy it. I have already explained, after you buy, it can go down further. The answer is yes, and you don't regret it. You have to enter the market. That's the bigger point that you should keep in mind.
Alright, so we say bye to this beautiful city of Bengaluru. It was a really fun investor camp, Sonia.
It was, truly. I mean, not just the investor camp, but the whole CNBC TV 18 Inside Bengaluru campaign taught us so much about the city and its people. But until we meet again in another city, thanks for watching the Investor Camp.
Focus, ideate, innovate, enable.